Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, a national underwriter for Old Capital. And joining me today would be Michael Becker, but he's not with us today because he is exhausted. We just got done with the conference with Gene Trowbridge, and he is going to be our guest in the podcast today. So we will miss Michael. But of course, sitting in Michael's spot, James Eng.
Hey, Paul, how you doing?
I'm doing great, James. You've got to be exhausted, too. Tell me what's going on for this last 72 hours with Old Capital.
We've had just a great conference. We had probably over 450 people on Thursday in Addison with listing brokers, property managers, owners, lenders, full thing. And then we had 4 or 5 open houses yesterday at all the major listing brokers. And then today, here on Saturday, we had Gene give investors a 4-hour seminar on syndication.
Unbelievable. What was your favorite part, James, in the conference on Thursday? How would you describe it?
I think just the energy in the room, not only, people interested in investing in apartments, but then also, wrapping up the day with Rob O'Neill, who came in and gave us really a lesson on teamwork and never quitting. People were just very energized, got a lot of education out of the day, and, really ready to get out there on Monday and hit the ground running.
Yeah, Rob O'Neill was fantastic. And if no one remembers that name, they should. Rob O'Neill was the guy who shot and killed Osama bin Laden. Not only was he involved with that exercise, but he also was part of Captain Phillips and finding Marcus Luttrell up in the Afghanistan mountains. Just an unbelievable speaker, high energy, talking a little bit about what he did when he went through SEAL training, and then not only going on SEAL training, then becoming into SEAL Team 6, the best of the best, and how he got involved with that and became kind of a team leader and an operator. So I thought that conference was fantastic. James, you did a great job putting it together, and we appreciate that.
Thank you, Paul. And we will look at doing one next year.
I love it. Sounds good. So in the podcast today, as I mentioned, we have Gene Trowbridge, and Gene just spoke with 70-some people here, just an unbelievable large crowd, on what's going on in syndication and how to do it correctly. I mean, there's so many different ways to not do it correctly, but it's a lot easier to do it correctly. So Gene is an expert and attorney out of California that came to Texas, and I thought did a great job. A lot of high energy in the room, and I thought we would kind of probe Gene's mind and see if we can have you understand a little bit more about doing syndication the correct way. So Gene Trowbridge, thanks for coming into the podcast.
Well, you're welcome, Paul. James, nice to be with you guys. Happy to do this.
We appreciate that. So I'm going to kick it over to James, and let's talk a little bit about syndication.
So I think what we'll do here is really look at the syndication market and maybe give us an idea of the size of the market, and then break it down into more specifically for commercial real estate, especially multifamily investors, why they go through syndication and the best way to do that. And then we'll wrap up with some of your sort of pro tips and what you've seen from doing this for a while. I mean, Gene is really seen as the expert in this area of the business. And so, Gene, maybe you can talk to us about just sort of how you got into this business, and then we can go from there.
All right. Well, I am in my third career, actually. My first career was as a commercial real estate broker. Did that for quite a while, and then I decided I wanted to try being a syndicator. I started out with some friends, bought some properties, and grew into a full-time business for me for about 18 years. And then somewhere along the line, I knew I was getting tired of taking care of partners and their money, and I thought I would do something different to allow me to stay in the industry, but without the headache of a partner's. So I went to law school. And James, at 45, I graduated from law school and started the third leg of my career, which would be, or my third career as a syndication attorney, and I'm still going strong today.
That's great. And so I guess when you look at the size of the private placement market, maybe give us an idea of how much money is raised in this market.
Private placement market would be a market where we talk about the sale of securities that aren't registered with the SEC. And in 2016, the number was about $1.6 trillion. And that's a really big number. That's more money than was raised on the public Wall Street marketplace during the same period of time. And about 30 to 40% of that money we think is in real estate. So that's a very large, very, very large marketplace.
And then in terms of size, what are typical sizes for these equity raises? What are you seeing maybe on average, and then maybe typically what the median is on these size deals?
Well, the SEC reports that the average size, when they took into consideration, I think it was 48,000 offerings, was 30 million. But the median is just 2 million. So there's a lot of deals out of that 48,000. There's 24,000 that are 2 million or less. So there's a lot of small deals with 10, 15 investors going on. And that's very exciting. That's really the marketplace that our firm works in. I would say that our median is maybe 3.5 to 4 million, and we do offerings from 300,000 to 130 million, and there aren't very many at 300, and there aren't very many at 130 million, but we do an awful lot of offerings between $2 and $5 million money raised. So that should buy us, $5 to $20 million apartment buildings.
So maybe step back a second and give us an idea of why people are doing syndications. Why are, general partners doing syndications in the first place? And then, eventually these guys have to get paid. So maybe talk about how these people that are putting these deals together are getting paid in these transactions.
Well, as I always say, the reason you do a syndication is you've run out of money yourself. You don't have enough money yourself to buy all the real estate you want to own and control. So you reach out to other people, and other people need your services. They need your expertise, and they're happy to put their money with you and let you make a good living while you are their fiduciary and manage their money into certain projects.
So explain that word fiduciary that you just used.
Fiduciary. I can go back to the Roman days when someone died. The fiduciary went into their house and took all their belongings and was in charge of distributing it according to their wishes. So a fiduciary is someone who takes care of other people's assets and follows through on their wishes on what should be done. And in our world today, I always say that as a fiduciary, you're in charge of other people's money and you should deal with it better than you just deal with your own money.
So when you start looking at that, the word, not only fiduciary comes up, but then also the word security. Mm-hmm. So maybe give the audience an idea of what constitutes a security, because a lot of people, they put these deals together and the last thing they want to call it is a security.
Well, that's true, because they know that if it's a security, they're going to have to deal with a certain set of laws. So they want to just avoid that at all costs. But simply, when a group of people invest their money in a common enterprise and they expect to make a profit with their investment, but the profit is going to come through the efforts of the promoter or someone else, some third party, that by definition is a security, an investment of money in a common enterprise with an expectation of profits through the results of someone else. So if James, just as simply as if I went to you and said, let's do this deal in San Clemente, and you put up $500,000 and I'll put up $500,000 and we'll do it together. You live here in Texas. You don't have to come and look at anything. I'll do all the paperwork. I'll get it all done. And when we're through, we'll split 50-50. That's a security because you invested money in this enterprise that we're together with. You expected to make a profit, hopefully, but I was going to do all the work. So there has to be some protections for you. And the securities laws were drafted to protect you from getting in a fraudulent investment with me and to protect you from investing with someone like me who maybe you shouldn't.
So the Act of 1933 put in some rules and define what a security is, but then every security must be registered unless what?
Exempt. Okay. So the rule is every security has to be registered with the Securities and Exchange Commission, the SEC, unless it's exempt from registration. And that's the way all of our clients work. And that's the way the $1.6 trillion was raised in exempt offerings. Exempt from what? Exempt from SEC registration. And in many ways, there's another term, it's called preemption. Not only is it exempt from the SEC, but it's preempted from the states applying rules that are more complicated than the SEC's. And we get an exempt offering and a preemptive offering if we do Regulation D, Rule 506. So how about that for a lot of vocabulary and a lot of numbers and everything?
So let's maybe walk. I thought there was a very interesting chart that you provided to our investors around securities, and it basically asked questions around. The first question was, who is going to manage it? Is it going to be member managed or manager managed? So if it's member managed, is that considered a security or not?
Well, an example of a member-managed one is an example you and I just talked about going to San Clemente. If I said to you, bring your $500,000, get on a plane, come with me, we'll look at the project. We'll decide if we're going to do this. We'll go to the bank together and open the bank account, and together we'll apply for the mortgage, and we'll make all the decisions together. Well, here we are, members of the LLC. There's no manager. We're doing it. All the decisions are unanimous. So the fourth prong of the definition of security falls apart because it's not through the efforts of someone else. It's through our own efforts. So if I wanted to, first step, put together a small group of investors and do something that wasn't considered a security, I'd want to put together a member-managed LLC where we all voted and we all made the decisions and no one was in charge. Now, James, that'd be okay for the two of us,
right? But
not for 27 of us.
Right. So it becomes more and more difficult to do a member managed.
Sure does.
And so when you go to the other side and it's a manager managed LLC, that's when it really opens up into the SEC world of security. And let's touch briefly on some of the other ways outside of 506, Reg D 506, the other ways that you would have to register with the SEC. So whether it's Regulation A+ or some of these other ones, let's touch briefly on those and then dig into Reg D 506, because that's where most of them are getting done.
In the securities world, without going to full registration on the SEC, one thing that we see common today is called a Regulation A, Regulation A+ offering. And that a type of offering really got new wings from the Jobs Act, which was passed in 2013. And Regulation A lets you go to the SEC, make application, and you get a permit. Just a permit. It's not full registration. You're not going to get on the New York Stock Exchange. You're not going to get on NASDAQ or anything, but you do have the ability with a permit to advertise, and to sell to accredited investors and non-accredited investors, sell to anyone really that meets your suitability standards, and it allows you to raise $50 million in a year. It's very, very popular for syndications that aren't necessarily real estate. In the real estate world, it'd have to be a blind pool because it's going to take you 4 or 5 months to get approval, raise all your money, then you go out and buy something. But it's really big in the tech world, and we've done solar panel companies. We've helped people start schools. We've helped people get patents for medical devices, all sorts of business opportunities, along with the blind pool real estate for the experienced operators. So that's Regulation A+, and that's pretty exciting. And then one other thing that we did talk about here in Texas was the ability to do a Texas-only offering. Actually, that's called an intrastate offering. So if you bring your offering inside of a state, meaning you're in the state, all your investors are in the state, the property's in the state, then only state law can govern, and no federal law can regulate you. So that's a good way to do a securities offering and minimize maybe your cost and your involvement. Of course, you don't have any involvement with the federal law, and do it under state law. The only problem is state laws are a lot like federal laws. You still run into some of the same problems. Sometimes they're even more restrictive. And then if you're doing a deal in Texas and one of your investors says that Uncle George from Arkansas wants to invest, you're stuck. You can't do it. You can't change horses. So most people just go right to Reg D, and that's where most of the money's raised.
So so within that Reg D, Rule 506, I mean, I think you said close to what, 90 or even 99% of that
all of the private placement money is raised in Reg D, and it's Rule 506 is primarily where all of our business is, and almost everything I do in Texas is 506.
So Reg D, 506B. So where would you actually see that, in a PPM, or if you get something sent to you, how do you know if it's a 506B, C? How is you as an investor? Is that anywhere in or is that just a decision that the general partner is going to make, and then let you know, and then you'll prepare the documents that way?
Well, in the deal structure interview that I have with a potential client, we talk about whether we want to go 506B or 506C, and the difference is advertising. If we're going to advertise, we'll go 506C. But generally, we go 506B, and then you would find that in some of the disclaimers in the first 2 or 3 pages of the private placement memorandum. They'll tell you how this offering is brought about under federal securities laws, and they will state the exemption.
So let's go through Reg D, 506B. What is that box? So what's allowed in that, and what is not allowed?
Regulation D, Rule 506, is the way Reg D has always been run since 1981. It's the most common way to do things, and I'll just kind of go through the bullet points. In 506B, you can raise as much money as you want. Remember, I talked about Reg A, and I said it was $50 million a year. Well, 506, and specifically 506B, there's no dollar limit. We recently did a $130 million offering in a 506B offering inside of 1 month. And that's where the $300,000 offerings come to, also in the 506B. But so you can raise an unlimited amount of money, and there's no time frame related to that. You can have an unlimited number of accredited investors, those who meet the accredited definition, rich, smart people. You can have as many of those investors as you like. When you ask the investors if they're accredited, they can just simply check a box and say, yes, they are. And I'll come back to why that works. And you can have up to 35 sophisticated investors. Now, they will not meet the dollar and cent definition of being accredited, but they have experience. They have advisors who can help them make a sophisticated investment decision to see if the investment presented to them is within their risk tolerance. And why can you do just self-certification? And why can you have sophisticated investors in a 506B? It's because you can't advertise.
So you can't advertise.
They know you and you know them.
So pre-existing relationship.
That's the technical term, another vocabulary. A substantial pre-existing relationship, meaning that you know enough about them and they know enough about you prior to seeing any offering that you think the offering is suitable for them and they think you're the guy that they should invest with.
So the 506B, is majority of the money is being raised in that. Still in 506B, and a couple of reasons for that. Number one, 506C is new, so it's going to take a while for that to When did that
get
come
you.
out? Just the last couple of years?
2015, I think the final regulations came out. Secondly, if you're an experienced syndicator, you don't need to advertise. You already have plenty of investors. Yep. They're rolling their money. They're giving you referrals. And you're probably good at building your database of pre-existing relationships. Those would be the two major reasons. Plus, I guess, in reality, there's a lot of sophisticated investors with a lot of money. There's a small number of accredited investors. About 3 or 4% of the tax returns in the country are accredited, but that leaves, up to 97% of the tax returns could very well be sophisticated, and they have a lot of money in their 401ks and their IRAs, and it's a good source of money.
So the last piece of the 506 is the 506D. The bad actors.
Well, we haven't talked about 506C.
Do you want to go? Okay. Do you
Let's
want to
go
back to that one?
Yeah,
Yep,
506C is everything I just said, except you can advertise.
Okay.
So we'll go through the bullet points. Raise as much as you want. An unlimited number of accredited investors. No sophisticated investors. You can advertise. Because you can advertise and take people you don't know, we're not going to let them just check the box. We're going to go through a step-by-step approach to see if they are accredited. I, as a syndicator, would have the burden of showing that I had a reasonable belief that every investor I had was accredited. And so there's a process to that. You can hire a third party. You can just go through 4 or 5 steps that the SEC has outlined. I could ask you for your tax returns. I could get a letter from your CPA. I could get a letter from your stockbroker. I could look at your audited financial statement, prove to myself, so I'm reasonably assured that you're accredited. And then I could take you whether I know you or not, James.
So a lot of these maybe crowdfunding platforms are using this 506C versus the 506B because
almost every crowdfunding platform has gone to 506C, where what does the crowdfunding platform do? It gathers a database of accredited investors by telling them that if you come to our platform, you will get to see all these great offerings because we're going to attract great sponsors to show you their deals. And then they go to great sponsors who say, gee, I'd love to put my offering on your platform. It's almost like an MLS of offerings, okay? Put my offering on your platform, and they disseminate all the information to all their accredited investors who, if they are interested, contact me to purchase. Now, some crowdfunding platforms will do 506B. This might be in the weeds a little bit, but there are some crowdfunding platforms that have their own broker, dealer, or registered investment advisor affiliation. So they already have a relationship with people who have relationships with investors. And so they can take the offering and tell their stockbrokers that they have a deal, and the stockbrokers talk it to their investors, and it's covered under 506B. But most of the crowdfunding platforms are advertising.
So the question I had is, I understand the 506C. That's pretty common information because you can advertise that. It's a crowdfunding piece. My question goes back to the 506B. The max was 35 sophisticated investors. What determines what a sophisticated investor is and what's a non-sophisticated investor?
A sophisticated investor, there's no bright line rule, but as it's explained in many places, no action letters or at the SEC or articles, it's an investor who alone or with their advisors has enough business and economic knowledge to make a decision for themselves that the investment they're about to make fits within their tolerance for risk.
So somebody that is part of an educational group that learns something about multifamily, could that make that person a sophisticated investor?
I work with a number of large mentoring groups, and my position is that if you've taken all the education that those mentoring groups provide, I'm going to advise my client that they are sophisticated. I also do some work for the CCIM Institute, and if I knew you were a CCIM and you'd taken all the CCIM education, I'd say you were sophisticated.
If you can pass the test and fill out their forms, then you're sophisticated.
That's right.
So jumping back just to wrap up 506, maybe touch on, I guess, the 506D, sort of when that came out and what that applies to.
When you get hired with a securities firm to sell securities, you are going to be under the 1934 Act, which is going to allow them to license you. In order to get licensed, you have to go through a severe and a lengthy background check before they will give you a license to sell securities. None of my clients have to go through that. My clients come to me, we write the offering documents, I hand it off to them, and they're out there raising money with no background checks. It would be nice if everyone had a biographical piece in their property package, but some of those are not as detailed as you like. So Dodd-Frank, about 2012, came along and said, let's have some background checks on sponsors. So they call it the Bad Actor Questionnaire. And it has two parts to it. The first part is, do you have to fill this thing out? And you have to fill it out if you're a general partner, if you're a managing member, if you're an officer or a director of a firm that is going to handle investments from other people, or if you yourself are going to invest more than 20% in an offering, because the SEC is concerned that as a 20% owner, you could conceivably take control of the money in the company. So that's the first question. And so every client I have has to fill out a bad actor questionnaire, and they're always going to check the box. Yes, it covers me. And then when we go through the money raising, if my clients are going to take investors who will invest more than 20%, we're going to have those investors fill out, say that, yes, the questionnaire applies to me. Okay. So that's the first part. Does the questionnaire apply to you? The second part is, well, what are we interested in? We're interested if you've done anything criminal as it relates to managing other people's money. Is it criminal? Have you just been disbarred? If you had been an attorney and you'd been disbarred from mishandling a trust account, if you've been a CPA and you've been kicked out of the CPA organization for misrepresenting clients, if you've been convicted of postal fraud, anything that has to do with mismanagement and being a bad actor as it's related to other people's money, you'd have to check. So here's the questionnaire. Do you have to fill out the questionnaire? Yes. Have you done any of these things? Hopefully no. But if, in fact, yes, you've done any of those things, then there's ramifications. And the ramifications is, number one, if you did it before September 23rd of 13, we have to disclose it in your offering documents. If you've done it after that date, you're precluded from selling securities for 10 years. And who gets that bad actor questionnaire? I do. And so I'm kind of the policeman. I have to get the questionnaire, I collect it, I keep it in my files, and I have to follow through. I either have to tell the client we have to put the information in the private placement memorandum, or I tell the client that we can't do business with them. And then I keep that on record for 7 years. And I don't have any responsibility, James, to investigate your answers. You attest, which is just like testifying under oath, that what you're telling me is the truth, and that's the only responsibility I have. But the SEC has put that burden on the securities attorneys to ask those questions.
So once you figure out, all right, what regulation 506B or C that you're going to do, and then you fill out your form for D, and all that checks out, now you actually have to put together your PPM.
Right.
Maybe go through, there's a lot of things here on the slide that encompass the PPM, but maybe the top 2 or 3 things that you see that maybe aren't in every PPM that should be there.
Back to the 33 Act Paul talked about. The 33 Act is designed to protect investors from fraudulent investments. The way they're doing that is to require material facts be disclosed to the investors ahead of their investment so then they can make an informed decision. One of the rules under Reg D, Rule 502, says, hey, you have to give everyone a private placement memorandum. There's some exceptions, but generally you have to do that. And then in that rule is something called Guide 5. And Guide 5 tells you what should be in a real estate private placement memorandum. And you would think the normal things, what are we going to buy? How much money are we going to raise? How are we going to spend the money? What type of suitability do we have for the investors? How is money going to be distributed? And what are the fees paid to the sponsor? Those would be pretty normal stuff. Here's where I think a lot of PPMs fall short, and I think that was your question. PPMs fall short if they don't have an adequate discussion of the risks. A boilerplate PPM will say the same risks, and you could read the whole section on risks, and it could be 20 pages, and you'd have absolutely no idea what the property is. You wouldn't know if you're buying a Walgreens or a marijuana facility. You just wouldn't have any idea. A well-written risk section talks about, well, the risk of this apartment building in Houston is mold. Okay? So I can talk about this is in Houston. It's been subject to hurricanes and it's been subject to this. There could be mold. The risk in Minnesota is ice storms. And so you go specifically through all the risks. A next area that isn't always covered adequately is conflicts of interest. Are there conflicts of interest between the manager and the members? Possibly between the members and the members? Possibly other offerings that the manager has and this offering. We need a full discussion of those conflicts. The things that I see coming up over and over are the liquidity section. This group of investors, their lives change. If the investment is 5, 7, 10 years, something's going to happen to someone, and they may need their money back. It could be a wife dies and the father needs the money to help with the kids. Both parents die. How are we going to do with this? Someone has a heart attack. Someone goes bankrupt and the court wants to come in. How are we going to deal with liquidity? Well, a well-drafted liquidity section is invaluable in those situations. And then the other one would be dispute resolution. If an investor gets a bug up there, and is ready to start causing legal problems, how are we going to deal with that? And the dispute resolution is always between investors and the sponsor. And we have to be careful that an investor can't go nuts and ruin the whole investment for everyone else. So we have a well-developed dispute resolution thing. So I think the things that specifically I'd look at if I was an investor that would stand out to me, other than the boilerplate stuff, would be dispute resolution, liquidity, conflict of interest, and risks.
So you've done probably hundreds of these PPM documents and worked with a lot of syndicators. Maybe in your presentation you went through maybe Gene's 3 truths Maybe give us those and sort of why you say those.
Okay, that slide was for people who want to be syndicators.
For syndicators. So
Okay.
we
not
have
so much for the
thousands,
investors.
yeah, so
right?
we have thousands of general partners who listen to our podcast. So maybe let's go through those for them.
My first one is if you start a deal, you absolutely have to know how you're going to finish it. The risk of not being able to finish it to the sponsor can be severe financially. If you give investors money back because you can't complete the raise, that's going to be difficult for you to get money back from them on your next deal. When I was syndicating, I had a certain amount of assets that were either cash or could be converted into cash easily, so that I knew every deal I brought to the market, if money raising was slow, I could still close, and then we could continue to backfill and raise money. That was important because when I was raising money, I went to the broker-dealer community, and they raised the money for me. But they didn't want to raise money if they didn't think I could close the deal. So I had to show them. It's almost like going to a seller and saying, proof of funds. Right. Okay, I'm going to my investors and saying, I can close this deal. We'll raise all the money we need, but I can get this deal closed. Don't worry about that. Send me your money and we'll move on. So that's the first thing. The second thing was when I was raising money, I learned quickly not to delegate the responsibility to get that money raised to other people. You really have to stand on top of that and get the money raised. And the last thing is not to delegate communications to anyone else. The investor thinks you have their money. If they want to know where their money is and how their money is going to be handled, they're going to call and ask for you, not your associate. They might be able to do an address change, or will you send my check to a different place because I'm going to be on vacation this quarter. But if something's going wrong, or they think something's going wrong, they have to get to you. Not everyone is going to like what I say right here. I put my home number in every PPM I ever wrote. I had 1,667 K1s go out one year. I had 850 individual investors. Everyone knew my home phone number, and in 20 years, I only had 2 phone calls at home. They won't abuse it, but they felt comfortable if they knew where to call, where their money was, because I had their money.
Go back to that. You cannot delegate money-raising responsibility. So some syndicators have proposed to us is that I'm the operator, I'm putting the deal together, and I'm going to hire my brother Stanley to go out there and raise the money, and I'm going to pay Stanley a fee to raise all the money into the deal.
And I know your answer to them was, don't do that.
That's right.
Don't do that. That's right. Well, one of the rules that we haven't talked about way back when is the rule of 1934. The second rule that the securities legislation brought together was to regulate who's selling these investments. And that rule establishes how you get licensed. And the rule generally says you can't get paid for selling a security unless you have a securities license. There's an exception to that rule, James. And the exception to that rule is, I call it the for sale by owner exception, but it's called the issuer exception. And it says that you can sell your own securities without a license. You can't sell someone else's, and your brother-in-law can't sell yours. So if I'm going to be an operator under your scenario, Paul, your brother-in-law is going to have to come into the manager LLC with me, have a job that's other than just money raising, and is not going to get compensated based on the amount of money they raise. The rule says there is no transaction-based compensation unless you have a securities license. So if your brother-in-law and you were in the deal and he was supposed to raise all the money and you said, if you raise all the money, I'll give you 30% of what I get. Mm-hmm. If he doesn't raise a penny, he's getting 30%. If he raises it all, he's getting 30%. You're not promising him that his percentage is going to be based on how he raises money, because however you call that, that's a commission. Deal-based, transaction-based compensation is prohibited.
So you work with a lot of syndicators. What has been maybe some of the mistakes that you have seen them make?
Sure. Mistakes. And this list of mistakes that I went through, some of them I made myself. So part of the list was easy to generate, and then I watched the rest from other people. I would say one of the things that bothers me now representing a lot of sponsors is the sponsors are in such a rush to raise their money. They just want their documents. They want to get out. They want to collect their money. It's such a frenzy that they don't really read their documents. And the operating agreement is a contract between you and your investors, and it tells you how over the next 6, 7, 8 years, everything is going to run. You should probably read that. That's the most important one to read. So I like that. Taking investors' money before you have your investment company's bank account set up. It's the investors' money. The investors own part of the investment company. Their money should go into that bank account, not your bank account. I find sponsors who, in the interest of keeping their reputation up, keeping their track record up, when it comes time to make a distribution, and then maybe they're a little short of actual earnings, they take money out of reserves and they distribute that, and they tell their investors that that's part of the earnings. That in court would be fraud. What they're doing is they're giving their investors part of their money back. They're giving them a return of their money, and they're telling them it's earnings, which is a return, and so it's totally misrepresentation. Not having enough time to raise your money. Don't stress out your investors. And for those of you who are listening to our investors, if you sense that a sponsor's coming to you and he or she is really stressed out about timing and how quickly you have to get their money to them, I would take a second look at that. I know there's one I'm missing that is just Paul is pointing at one that's pretty self-serving. It's don't draft your own documents. Hire a professional to draft your documents. I wasn't going to say that one.
No, I'll say it because what happens is it's that so many people think that they're in the syndication business. And I mean, attorneys think they're in the syndication business. There are attorneys that are specialists. There's medical malpractice attorneys. There are attorneys that do contracts. There's attorneys that do, 15,000 different disciplines, but you really want to be somebody with, this is what they do. This is the business that they're in. You want to work with somebody that knows what the hell they're doing. And so, Gene and his group is the group that knows what the hell they're doing.
That's what we do. That's what we all do. And that's a good comment. There are a lot of attorneys out there who know an awful lot about the syndication business, but because they work for a large law firm, they're prohibited from practicing in this field because the law firm doesn't carry malpractice or E&O insurance on securities work. It's very, very expensive. There are sole practitioners who know about this, who could do the work. They don't carry E&O insurance either, so they either do and they're not covered, or they stay away from it. When I became an attorney, my policy was for myself, and I practiced law by myself for a long time. I went right out and I bought E&O insurance. One of the courses I took in law school was how to be a solo practitioner. I had to put together a business plan. After renting an office, the second thing I had in my business plan was E&O insurance, and we're totally covered on all of our all the work we do. That might be a question a sponsor might ask an attorney.
So when I see sometimes with these PPMs that are built by other attorneys, not Gene and his group, they're fragmented. And so a lot of them take a little information over here, a little bit of information over here, and it just doesn't flow. It's been stolen from somebody else's information, and that just doesn't work. You need to have this information crystal clear. You need to work with a professional that knows what the heck they're doing. This is what they do inside and out. And James, how many transactions do we do that are syndicated?
Out of 35 transactions I've done year to date, there's been 34 syndications. So almost every one of them, close to 90-95% of them are syndications and not.
Yeah, this is something that you really do need to pay attention to if you're thinking about raising money, other people's money. And I always like Gene's analogy about an airplane and how simple what a syndication is. Somebody wants to go to California here, and it's as simple as trying to get on an airplane.
That's right. And there are all sorts of things we do in life that are syndications. And my airplane example is I don't own a plane. I can't fly a plane. I want to get home to California. So 140 of my closest friends and I pool our money. We get professional equipment and professional management, and we get there. I'm a little older than you guys, but I'm buying long-term healthcare insurance because I'm not going to be able to afford that myself, so I pool my money. In that, there are all sorts of things we do in life that we pool our money to accomplish something. In the syndication world, it's usually two or more people pooling their money to accomplish some business goal. That's a simple definition of syndication. We do that all the time.
Yeah, that brother-in-law of mine, not only does he want it to earn a commission, but he has a buddy of his that wants to put $300,000 in because he has 1031 exchange money. And he said, hey, listen, do you guys have any syndications available that I can put this 1031 exchange money into the deal because I got a date that's coming up here? Gene, what do I tell my crazy brother-in-law?
1031 money, or let's put it this way, money that comes out of a real estate investment that wants to defer capital gains under Internal Revenue Code 1031 has to buy real estate, not interests in an LLC. The LLC owns the real estate. The people own personal property. It doesn't qualify. So your brother-in-law's friend can't use his $300,000 in the LLC. But at some point in time, the LLC, which has title to the property, can do an exchange for another property. You go from real estate to real estate. That's as simple as the 1031 rule is, like kind. And that works, but that's hard to turn down that $300,000 if I have to close on Tuesday and I'm $300,000 short. So I think you want to have some credibility and give the investor the right answer.
So people don't get into that type of situation. We're sitting here on Saturday. Your final slide was, what should you do on Monday? So maybe walk through for those people who are maybe their first, second, third syndication. What should they be thinking about and what action steps do you have for them?
Well, James, I hope some of the stuff we've talked about today will be good for the experienced syndicator. Maybe when I teach and do training sessions, there's always a couple experienced people, maybe even who have come to hear me the third or fourth time, looking for one thing that'll help them be better. And then there are people listening who want to be investors. And this message isn't for either of those. These are for people who are going to go out Monday and say, yes, I want to be in the business. The first thing I say is find a partner to do this with. Because one of the questions you'll get is, James, I'll invest in your deal, but if I give you my money, what happens if something happens to you? Well, you've got to solve that. The lender wants you to solve that question. The investors want you to solve that question. You've got to protect everyone. So have a plan for continuity, and that means there are going to be at least two of you doing this. Number two is you're going to build a database of potential investors. And you're always building a database. Remember in The Wizard of Oz, the good witch comes down in this bubble? That's my feel of building a database. Everything I'm doing inside of the bubble is syndicating, but the bubble is my database. I'm always building my database, and I take it with me everywhere I go. It's everything that I do is the database. Then pick a specific property. Your first offering has to be, we're going to buy that property right over there. Here's the brochure, here's the pictures, here's the rent roll. There's nothing left to guess, yes or no, okay? Make your first raise between $1 million and $1.5 million and know that you can fund it. If you're a little short a week beforehand, can you come up with the money to make up the difference? If you start, you must close. Structure your fees so that you don't try to make all the money up front. Make money as your investors make money. This is really a long-term business. Your investors will let you get paid as long as we're sharing in the profits. We're not taking advantage of them and taking too much money up front. I don't know if I said that I went to law school when I was 45. How could I go to law school at 45 and take the time to do all that? I had 16 syndications out there paying me fees, residuals, management, shares of cash flow. I basically went into the asset management business for 4 years. I had plenty of revenue. Okay. Give yourself 6 months to complete your first deal. You should have a deal ready by March if you start next week. Don't delegate money raising to anyone. Make sure your first deal is a success. Get it started, find the property, raise the money, and close. Start managing the property. One of the questions an investor is going to ask you, the second question they're going to ask you is, James, have you done this before? Let's get this first deal done so you never have to answer that question no more than just the first time. Don't quit your day job. You're not going to make a lot of money on this until you get into bigger properties and you get more of them. Run your syndication as a business. Just remember, you have someone else's money and you've got to manage that money. And it's a business. It's not a hobby. It's a business. So that's what I think you should start doing Monday. And if you do that, you're well on your way. And I didn't even say in there, hire a professional set of team members to work with, lenders, attorneys, property managers, title companies. All those people are inside of your bubble as you make a team. That really, really makes it work.
Well, Gene, this has been amazing today. Just your 4 or 5 hours of sitting with our investors, and then also just to me, it was just one of those. We were as if I was walking in the fog for the last couple years, and then you came in and put glasses on and cleared up the fog, because I think there's a lot of confusion on a lot of these rules. And so you hear one thing here, another thing at another place, and people are trying to put it all together. But you having all the information in one place has been fantastic. So thank you for being here.
You're welcome. I always say when I'm standing in front of a class, why would you, that I'm teaching like this? I hope I said it today. Why would you take a class from someone who doesn't do this every single day? Why waste your time?
Yeah, Jane is definitely the specialist when it comes to syndication. You want to talk with them. If somebody wanted to reach out to you, can you give me two things? Can you give me really your website for one? And also two, are you guys doing any type of educational stuff that's coming up anytime soon?
All right. Our website is crowdfundinglawyers.net. And you can find me at gene@crowdfundinglawyers.net. I'm very accessible online, very accessible. You may send me an email. I may call you right back, but I'm very accessible. And Crowdfunding Lawyers does have several workshops during the year, and you'll find out about them on our website. The imminent one is our annual event in Las Vegas. Coming up next year, the Thursday and Friday before Super Bowl. Mm-hmm. I think it's the 1st and 2nd of February. It's at Mandalay Bay, and it is called Crowd Converge 2018. It's a place where sponsors gather, and we try to educate sponsors as to who the service providers are in the industry that will make sponsors' lives easier so sponsors can move on to bigger and better deals. As I said this morning, I sent out 1,676 K1s one year. There were no companies in business at that time that could have done that for me. Today, there are 10 companies who could handle all of my back office operations, and some of those people will be there. Some of the crowdfunding platforms will be there to help you raise money. Some of the accountants and some lenders actually will be there to help you to raise money. So that's a great event. It's a day and a half. It starts Thursday morning and ends at 2 on Friday, so you can get home if you need to. and you can find out about that on the website.
Great. Great information, Gene. We appreciate that quite a bit. James, I know that we just had this fantastic event, not only today, but also last Thursday. And Gene's exhausted. I'm exhausted. You have got to be exhausted. But anything else that's coming up in the Old Capital podcast world?
No, I think just real quick, I mean, if you like what you're hearing on the podcast, definitely go give us a review on iTunes or Stitcher. And, any questions, if you haven't gotten our white paper, go to oldcapitalpodcast.com and you can request the white paper right there.
Fantastic. James, thanks for leading the podcast. Gene, thank you. Tip of the cap to you. You did a great job today with 70 people listening to your stuff. It was amazing. All the heads were nodding up and down. They got it. And you are definitely the godfather of real estate syndication. So we appreciate you spending some time with us in the podcast. I'm Paul Peebles. Have a good day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.